It's the one-year anniversary of Donald Trump's election, a gubernatorial election surprise, President Trump's trip to Asia, GDP record growth, and a third quarter earnings update. What's in your portfolio? Here's what's moving the markets and your money. And there's a lot moving your money today. I'm Charles Brown. It's Wednesday, November 8th, and this is CB3 on 3. 3 on 3 covers social and political, news and fundamentals, and technical analysis influences on market behavior and thus your money. Together, these influences determine the movements in all the portfolios we manage. Here's what we're seeing this week. In social and political events, we all remember what happened a year ago today. Donald Trump pulled off arguably the most shocking upset in presidential election history, with apologies to Harry Truman. Major networks begrudgingly gave Mr. Trump the nod just prior to midnight, November 8, 2016, 1 year ago today. Politics aside now, why do we care as investors? Well, the average gain in the Dow Industrials 1 year after a presidential election is about 6%. And here's where we are now just 1 year later, a staggering gap higher over the historical average I just showed you. Again, as investors, it doesn't really matter what our opinion is of Mr. Trump. The market's opinion has been one of optimism, as the buying of equities has been almost relentless. Certainly low interest rates have also favored the current environment. And consumer confidence at record highs, which we showed you in last week's episode, is also a major factor. But forget a year ago, now the markets are digesting just what happened yesterday, a day ago. Democrats swept and Republicans wept in gubernatorial races in Virginia and New Jersey. Especially in Virginia, a swing state, those two victories could bode well for Democratic chances to make congressional gains a year from now. This sets up for a 2018 showdown in both the U.S. House and Senate to see if the Trump-led pro-growth mindset will continue, or will it fall flat on its face due to congressional deadlock. As your portfolio manager, what's our take? If the Republican-driven pro-growth engine falters and sputters, you can say goodbye to this bull market, a bull market now well into its 8th year. We don't fear that possibility, but we certainly would be adjusting your portfolios were this tide to change in 2018. Yes, we monitor this tide daily. In other political news, American and Chinese companies signed more than a dozen deals worth $9 billion as President Trump arrived in China earlier today for a visit likely to be dominated by tough trade talks and tensions over North Korea's nuclear program. As your portfolio manager, we watch the tenor of these international trade developments because they can and do affect cross-asset valuations, which trickle down to your stock holdings. In news and fundamentals events, the third quarter earnings season is beginning to wind down, so how are we looking at the valuations? Well, yes, there's a lot of data here, and if you're having trouble seeing this slide, I'll take it full screen for you. There's a plethora of factors that determine the historical fairness of valuations and what I call the buyability of stocks. These are some of the many factors that we monitor every quarter. And now that the earnings season is winding down, we're reviewing most of these factors in our mid-quarter portfolio valuation meetings as we look at the third quarter to date earnings scorecard. This scorecard is a sector-by-sector ranking of those stocks that beat and those that underperform their earnings estimate. Again, I'll take this full screen for you to be able to see it a little easier. Now, what does this data mean to us as your portfolio manager? The underlying economy remains strong and the economic data continues to impress us with upside surprises in the consensus predictions. This strength gives us staying power should the market experience a minor pullback over the course of the fourth quarter. I'll have more on the third quarter earnings scorecard in my next Money Lessons, episode 7, later this week. You'll find that video on our website and YouTube Money Lessons channel. In other fundamentals news, GDP beat the 2.7% growth estimate to clock in at a rousing 3% for the second quarter in a row. This 3% number is the target that many of us in the industry use as a benchmark for sustainable economic growth for the U.S. economy. We now have back-to-back 3% plus growth in the U.S. economy. We have not seen back-to-back 3% quarter growth in, well, you guessed it, more than 8 years. In technical analysis, as many of you likely know by now, many of the trading decisions we make for your portfolios are derived from technical analysis, using an indicator known as relative strength. To measure relative strength, we use a tool called relative rotation graphs, or RRGs. We can use RRGs to determine which countries are beating the U.S. markets and when the U.S. is beginning to gain relative strength versus other economies. Now, when I remove the clutter on this screen of international markets and just focus on the U.S. markets, you can clearly see the Dow, Russell 2000, and S&P 500 are moving northward on the compass versus developed and developing countries in the world here in the fourth quarter of 2017. And that's what we want to see. The Dow is firmly headed higher in the green or leading quadrant. The Russell 2000 small cap and the S&P are moving due north in the blue or improving quadrant. I'm encouraged by the timing of their trajectory as we head into late November and December, which are seasonally strong performance months for the stock market. When technical analysis and seasonal favorability converge, good things can happen to our portfolio holdings. So now as I drill down into the S&P 500 RRG and review the 11 sectors that comprise all the companies in the S&P, the sectors showing the most strength are the risk-on sectors: energy, financials, and information technology. Industrials and consumer discretionary, heading due north, are showing the greatest potential appreciation right now, even though they're currently in the lagging quadrant. I like their trajectory heading north, especially at this time of year. The question we at CB3 continue to monitor and ask for your benefit is this: will S&P earnings continue to improve enough to support these traditionally high stock market valuations? As we are now another week closer to the end of 2017, our answer remains a solid yes. And that's CB3 on 3 for Wednesday, November 8th. Please give us a like if our commentary is useful to you. I'm Charles Brown, and at CB3 Financial Group, we don't just manage your assets, we become one of them.